Hello traders, Jeff with OptionBoxer.com, bringing you another strategy video today discussing the bull call spread strategy. Now, as I always do, please know that I'm not a financial advisor and this is not a recommendation for you to buy or sell any security. Trading is very risky and you can lose money. So that being said, let's go ahead and just dive right in here. The bull call spread strategy is a limited risk, limited reward play, meaning that it's kind of a hedge position, so to speak. Or not so to speak, it's a hedge position. The bull call spread is one of 4 variations of the vertical spread, and you should look to use this strategy when the expectation for the stock price is higher. So if you think the stock is going to be bullish over the, I don't know, next week, 2 weeks, month, year, you can set up a vertical spread here and a vertical call spread to take advantage of that. And the real benefit here, I guess I should go back to this page. Some of the key benefits are it's lower cost than a long call. It's a hedge position, which I just mentioned, and there's a higher rate of success than just the long call alone. So let's kind of look at an example here and kind of talk through it. You can see I've already got this pulled up on the screen. You can take a look at the Greeks if you're interested to do that. Set the slices to break even. You can see we've got these two numbers right here indicate that we've got a 56% probability of a loss on this particular trade. This is not a trade I've entered. This is just a trade I'm looking at. And we've got a 43.75% chance of success. Again, these numbers reflect this trade at expiration. Kind of something I would like you to think about, though, is these numbers, while they reflect at expiration, these probabilities can go way up if you get out of this trade prior to expiration. Let's say you decided you're only going to hold this thing for a week or 2 weeks, or you have a profit target of $10 or $20. These numbers really mean nothing if you're not going to hold this trade until expiration. Now, if you enter every vertical spread you place and your expectation is to hold it until that expiration date, then these numbers become way more meaningful. I mean, they are nice to see. Of course, if you're going to set up a high probability trade, you'd like to see a higher probability than 43%. But if you're going to get out of this thing in 2 weeks, these numbers really don't mean much to you. So just know that going into this. This is again a hypothetical trade on Apple. You can see Apple's been in a downtrend, so entering a bull call spread at this point would probably not be the best trade to make, but just for the sake of this video, I wanted to have something to take a look at. You can see at expiration, if it stays above the, let's see, if it stays above the 170 level here, you would receive the full profit, which is $257. If you hold to expiration and it goes below 165, you will of course lose all $243 that it cost you to enter this trade. Now, what I want to show you is, so I've got the long 165. So if I bought the long 165, let's analyze that as well. Tied this vertical. Set slices to break even. You can see, number one, our probability of success is considerably lower than the bull call vertical spread. And number two, you can see that we have placed a trade. The vertical spread cost us $243, whereas the long call cost us $1,040. So pretty staggering difference in the amount that it cost us to get into this trade. You'll also notice here, I didn't talk about it much in the last when I was looking just at the vertical spread, but take a look here at theta. So, well, that's not correct. We need to set the slices back to break even. So theta is right here at -8 cents. So basically what that is telling us is that every day that passes, we're losing 8 cents. Now let's take a look at theta for the long call. For every day that passes, we're losing $7.82. The benefit here, of course, with the vertical spread is that theta is mitigated. So instead of losing pretty much $8 every day, you're only losing 8 cents. Several days pass and you're still not losing that much. So theta doesn't really hurt you as bad on the bull call spread. So that's certainly a benefit and certainly a reason to want to trade the bull call spread. Now, For the long call spread, take a look at this blue number over here. So if it stays below, let's see, if it stays below 175 at expiration, you're going to lose everything. But look at that number grow exponentially as price goes higher and higher and higher. You can make a lot more money, I guess, with the long call option, but you also stand to lose a lot more. So that's where the bull call spread comes in. In all honesty, when I was a younger trader, I traded this a lot and I had some success with it. But I think the most important thing to know about the bull call spread is don't enter this trade and expect to make $257. I think that was probably my biggest mistake when I started out trading this particular strategy. Is I always wanted to get closer to that maximum profit number. The best way to play this strategy is to wait a few days, maybe a week, 2 weeks, see if you can't catch a move, 5 or 6 points higher. Take your $20 or $30 profit and move on to the next trade. That's probably the best advice I can give you with regards to the vertical spread, or the vertical bull call spread. But feel free to adapt it, change it, do whatever you need to do. Of course, you can always widen the strike prices here. Adapt it to whatever fits your particular needs. But hopefully that was a good enough explanation. I'm trying to close this video out under 10 minutes if I can. And so I'll let you take it from there. If you have any questions, feel free to reach me at optionboxer.com. Thank you for watching.